So let's straight away go into our work for today. So this is the question that we have, the past exam question. So it's a good standard question. This question will help us to further understand the concept, of valuations. The first bit is distinguish between the different types of synergy and discuss the possible sources of synergy based on the above scenario. Remember, we said in our notes that the justification that we have for two companies to merge, why two companies should merge. The main reason is we encourage companies to merge if we expect that there will be synergy. There will be that additional benefit. Anyway, only then do we advise that two companies should come together. So synergy really is the reason, is a justification for companies to come together. Where we are saying, if Hav and Strand continue to operate on their own, the value is low compared to when these companies are combined. And the difference between these two is what we call maximum acquisition premium. Maximum acquisition premium, that's what we call it. The other word is synergy. The other word is synergy. So as we saw in the other question again, when we looked at that question there, F and P, we noticed that on their own, their total was 180. When we combined them, the total was 189. So now you must get used to this pattern. The pattern that if companies operate on their own, the value is low. When you combine them, there's an added value. This value here, the difference is what we call the maximum acquisition premium, or we can call it synergy as well. And the synergy, or the additional value, is what justifies the combination. So in the recent exams, what we have seen is that the examiners have even now fed up of asking you to calculate the maximum acquisition premium. Maximum acquisition premium. The question has come again and again. So in this question, it will come up. Now, some of you will say, but you have skipped part A, which you are talking about. No. Part A says, where does this value come from? This additional value, or this additional value that we calculate here. Where does it come from? In other words, what are the sources of synergy? What is it that creates the additional value? The added value. What creates it? Now that was something that we covered in the notes. So what are the types of synergy that we have? What are the three types of synergy that we have? Number one,
Revenue.
Revenue. Number two,
Cost.
and the last one,
Financial.
So these are the sources of synergy, meaning when two companies combine, like this time we're talking about combining these two companies, the combined revenue, you'll find that it's more than the individual revenues. because you have got a bigger marketing power, marketing muscle. You have more outlets. You may even be buying in outlets. So you become much more competitive there. Cost synergy is quite a big one as well. The cost synergy is quite a big one. The advantage, we're likely to save on some costs. We'll minimize on duplication of resources. So we're going to minimize on duplication of resources. We don't have to invest in separate machinery equipment. No, a single set can work. Okay. The other advantage becomes the finance synergy. When it comes to borrowing, you're likely to borrow on better terms. Why? Because you're a bigger operation. Or there may also be tax incentives, such as tax reliefs in terms of the losses, which maybe somebody was not able to claim. You may take advantage. So this concept of synergy on this topic is one you must appreciate, the role of synergy in an acquisition. Now, when you come to our question here, having read through the scenario, where do you think that your synergies will come from? What are the sources of synergy in this scenario? Where do you think the synergies will come from in your scenario? Where will the synergies come from in our scenario? When you read through the case, did you pick some sources of synergy? Yeah, from our side, we have talented management. We've got talented management who have got a reputation for getting products to market quickly. We have significant cash reserves, finance synergy. So what we are bringing here, we are bringing cash reserves. We are bringing a talented management. What else? When you look at Strand has got skilled scientists. So don't have to employ scientists, they're already skilled scientists. They have already products. We don't have to develop products, no. So instead of having our own research and research development, we can get rid of one of the research sections and rely on this one. We don't have to expand our research section. So if we come together, there is what we don't have. There is what H hasn't got. There is what S hasn't got. But when we combine, we pull resources together, these will be in place. So there's a possibility of the cost synergy here. There's a possibility of the finance synergy here. These possibilities exist. Okay. Now let us come to the main part of the question. So there are two issues here. One, based on the two different opinions expressed by H and S, calculate the maximum acquisition premium payable. Now, in the worksheet that I shared, we already have some of this work already done there. Okay. So here we are. Let us start analyzing our work. We want the maximum acquisition premium. Maximum acquisition premium. So how will our answer look like? How will our answer look like? Let's say there are two opinions here. What are these opinions? Let's go through the opinions. Opinion number one, Strand Company is of the opinion that most of its value is in intangible assets. There's a mention of intangible assets here. Intangible assets. And this is what is likely to give us value, comprising intellectual capital. So we are seeing that we want to merge with a company which has got the intellectual capital already. And these are the aspects that create synergy. They've got the intellectual capital. Okay. Therefore, the premium payable on acquisition should be based on the present value to infinity of the after-tax excess earnings the company has generated in the past 3 years over the average return on capital employed of the biotech industry. I know some of you are saying that statement is Greek. That statement, you say it's Greek. How could the examiner expect us to understand such a statement surely in an exam? Is there anything that we are missing here? The answer is yes, there's something we are missing. This method is just a summary. This method is just a summary, or this expression is just a summary. A summary of a method for the valuation of intangible assets. This method is simply a summary. A summary of what? A summary of the method that you must use, you must learn in valuing intangible assets. Okay? So there's a method called calculated intangible value. Calculated intangible value. What does the method say? The method says that we can estimate the value of intangible assets by discounting what? The excess earnings after tax to infinity. So what can you pick here? You can pick two items. I think if there's something to pick here, there are two items. What is that? Discounting. What are you discounting? Excess earnings. We must discuss the excess earnings. Now your question is, what do we mean by the word excess? Excess to what? So the thinking here is that every business has got expected earnings. Expected earnings. According to the industry, there's an average earning that you expect. You compare this with the actual earnings on average that you have earned. So we are looking at an average figure. So the actual earnings on average, let's say you have been earning 120, but based on the industry average, based on the industry return on investment or return on asset, you're only supposed to get 100. So the question is, why have you been earning more? The answer is, there are some intangible assets that we can't see. And it is these intangible assets. It's these intangible assets that are giving rise to the excess earnings. So based on the tangible assets that we have, we're saying that you're supposed to get 100, but why are you getting 120? It's because there are some assets that we can't see. These assets are the ones that are responsible for the excess earnings, or in this case, your excess earnings of 20. Then you just knock off your tax, and then you have your net of tax. And what do? You find the present value. You find the present value. Or in other words, you discount these. Over what period of time? Over what period of time do we assume this will arise? To infinity. That is what we are going to do. So if you have picked that, let us read that statement again. Let us read this statement again together. Let us read this statement again. Okay? Are we together? Therefore, the premium payable on acquisition should be based on the present value. That is discounting, isn't it? To what? To infinity. Of what? The after-tax excess earnings the company has generated in the past 3 years. 3 years. Over the average return on capital employed of the biotech industry. So the biotech industry has got an average return. And even our company also is supposed to generate the same average return. It's supposed to generate the same. So let us now look at the facts. What is the actual average earnings? Let's go. The actual average earnings. Let's speak together. Are your calculators ready? Do I have calculators ready there? Mr. Mfwewa, is your calculator ready? This company, the earnings that you have earned is that one, and that one. These are the earnings over the past 3 years. These are the actual earnings. So these are the actual earnings that the company has earned. Get the average, please. You add up these 3 figures and divide by 3. Give me the answer. You can make it 1 decimal place.
So we have 84.33.
Come again. That
No.
plus that plus that divided by 3.
373.
373.1.
Just 373 flat.
373 flat. 373 flat.
Yes, 373 flat, yes.
Okay. So this is the actual average earnings. Are we together? We want to use the calculated intangible value. So this is the actual average earnings. So on average, in the past 3 years, we have earned 373. But what should we have been earning? Let's go to the biotech industry. Let's go to the biotech industry. Are we together? In the biotech industry, in this industry, what is the pre-tax return on capital employed? It's supposed to be how much?
20%.
Yes. Return on capital employed. Now, here's my favorite question here to my students. What does the term capital employed, what variables are covered by capital employed? Because this 20% should be applied on capital employed. So what does the expression capital employed cover? This is a question to you, all of you. Feel free to participate.
Isn't it the assets less liabilities, current liabilities?
It's what?
Total assets less the current liabilities, something like that.
Total assets less current liabilities. But for financial managers, I want you to explain it from what we mean by capital employed in the business. What is the capital that we employ in business? What are the components of the capital that is running around our business? What are the components? I always want it explained from there. Make it simple. The capital employed in business. What are the 2 types of capital that we employ in business? What are the 2 major sources of finance in business?
Of shares.
Yes, equity. We use the term equity. Please use the term equity. Equity.
Yes.
And what?
And also reserves.
Equity. So equity covers both. Equity covers share capital plus reserves. We call this equity. What of that one? That is your debt. So when you say capital employed in business, really, we are talking about equity plus debt. That's all. That's what we have employed in business. Is that okay? So next time you hear capital employed, basically we're talking about debt and equity. So let us now pick it from here. So equity refers to share capital plus reserves. So your equity is here. So this is your equity. And your debt is here. Low, non-current liabilities. Hope you're seeing where I'm marking there. So then let's add. So what is the capital employed every year? What is the capital employed every year? We don't need a calculator. 300 plus 400 is 700. And the figure is the same throughout. So it's simply 700 plus 183. What is that? 700 plus that. How much is that? 700 plus that. How much is that? Capital employed. Now we want the average. So what has been the average? So take this one plus that one plus that one, divide by 3. So what is our average capital employed? What's the answer? Come again,
869.33.
So on average, this is what has been appearing on the balance sheet. And your return is supposed to be this multiplied by 20%. That should be the average return. This is what we call expected return, based on the assets that you have on your balance sheet, or based on the funds that you have invested. So 20% of 869.33, what does it give you?
173.87.
173.87. So this is the expected return using 20% and the average capital employed. So let us now take to our workings. If we're all happy with what we have done, let's now come here. So 20% gives us that figure. So look at the logic. Look at the logic. The logic is you have been earning how much? You should have been earning how much? So we have excess earnings. These excess earnings, where are they coming from? Where are they coming from? Intangible assets. So we are assuming that these are coming from the intangible assets. It's the intangible assets that are creating these excess earnings. Then what do? We knock off the what? The tax. That's a tax. So this is after tax excess earnings. So this figure will be, we'll assume that this figure will arise over what period of time? In perpetuity. How do we discount the perpetuity? How do we find a present value of $1 forever? How do we find it? You simply take your $1, divide by the discount rate. So we take $1 divided by the discount rate. So let us talk about the discount rate. Let's look for the discount rate. Let's look for the discount rate, people. Where is the discount rate? Here, have we all seen the discount rate? Strand Company's annual cost of capital is estimated to be 7%. So this is our discount rate. This is our discount rate. Okay. And that is why if you checked on top here, that's what we have used. So you've got 159 divided by 7%. So according to the opinion of Strand, the maximum acquisition premium that they are willing to pay is 227.75.89. So that is the maximum acquisition premium. The added benefit should be equal to 2275. Now remember, it's the opinion of Strand. So if they are going to demand they can demand anything up to that level there. But we are saying we can share it out. So lesson number one tonight has been how to estimate the market value of an intangible. How to estimate the market value of an intangible. Using what method? What method have we used? CIV. What is CIV? The method simply involves discounting the excess earnings. And therefore, we have applied it in this particular question. They didn't mention it, but this is what the method is called. Are we okay with that part? Are there any questions on the CIV? Are there any questions on this approach? Okay.
Mr. Perry,
Yes, please.
This one is the B part, isn't it? Which has 6 marks.
Yes. And we haven't even finished. We haven't even finished. We just scratched it on top. Because they say using both opinions. So in the opinion of Strand, that's the value there. What is the other opinion? Hav. Let's look at the other opinion. Hav company is of the opinion that premium should be assessed on synergy benefits created by acquisition and the changes in value due to the changes in the price earnings. So these are saying, let's use the price earnings approach. Before and after. So this is another valuation method. So we have not seen a serious question using PE approach. So now we are going to see the first question using the PE approach, a serious one. So here they say, let us use the PE. Now let's remind ourselves, what did we say? The share price can be calculated by multiplying what?
E.
By? And if we're looking at the total picture, the value of equity can be estimated by, multiplied by the PE. Is that okay? So this is the approach we're going to use. How are we going to use it? How are we going to use this approach? Here we are. Here is what we are going to do. We are going to look at the value of the company before and after. Before and after. That is what we are going to do, before and after. Now, what we have seen is that some values may be given. What we have seen is that some values may be given.
Yeah, I was on the bed. My stomach was pain, so I slept like this.
Some values may be given. What do we mean? I'll be taking you back the questions that we have done together. I'll be taking you back the questions that we have done together. For instance, in the question, when we looked at F and P, we noticed that the value of P was given. This is the one that we calculated, and also the combined company. So this we calculated, that we calculated, but this one was given. When we looked at in the last class, we looked at M and N. What did we notice about M and N, people? What did we notice in the question? What was given?
There were shares and the share price.
Yes, the current share price for M was given. The current share price for N was given. The only thing that we did was we calculated the value of the combined company. And what approach did we use? What approach did we use to calculate the value of the combined company? What valuation method did we use?
Free cash flow.
Free cash flow to firm.
Yes.
You know, these questions that we get in financial management, they have got a formula, they have an approach. They're well structured. And if we follow the structure, you won't have a problem. Because the knowledge from one question, you can transfer to the next question and to the next question. And that's what I'm trying to do here, to show you that there's a link. Similarly today, if you look at our question, they have given us the share price for which company? It has been given. Hav company's current share price is 9.24. So where we are, this has been given. The only one which has not been given is this one is not given. And also the combined company is not given. So you've got two valuations to do here. What valuations are those? We need to value S and need to value the combined company. What approach are you going to use? What approach are you going to use?
Price earnings.
Price earnings. I hope you're following the approach. So now we want to learn how to use the price earnings to find the value of equity. We start with S. So for you to use a price earnings method, what do you need? Here's your answer. You need the PAT and need the PE. Only these two. Have they been given here? Let's go. The current PE of the biotech is 16.4 for the industry. And it has been estimated that Strand companies PE is what? 10% higher than this. The PE for Strand company is 10% higher than this. Higher than what? 16.4. So the PE for Strand is here. 16.4 multiplied by 1.1. Let's pause here. Let's pause here. This is the PE. The PE for who? The PE for who? For Strand. Next, what of PAT? Profit after tax. Where is our profit after tax? Let's follow it together. We come here. Strand is here. The profit before tax is 397. The tax rate is 20%. So what is their profit after tax? What is their profit after tax? Is 397 multiplied by 0.8. That's your profit after tax. So with all this information now, we can safely say, okay, so the value of Strand, the value of equity of Strand, as it stands today, the profit after tax is this one. The PE is that one. So you've got your profit after tax. You've got your profit after tax. And also you've got your PE. Please, can you take your calculators? Me, I put the formula here. Can you put your calculators? Take your calculators and you multiply this. Are you getting 5730? Are we getting 5730? So somebody has confirmed that that is correct.
730.
What we are learning here, what I want you to take home really, is how to find the value of equity using the PE approach. So these companies, if they continue to trade on their own, their total value of equity, their value of equity is only how much? Now let's look at the combined company. For the combined company, again, you need profit after tax. What is the profit after tax for the combined company? What's the profit after tax? Let's follow it together. No shortcuts. No shortcuts. Let's follow it together. You come here. This company, their earnings before tax or profit before tax is 1980. This one, 397. So then their profit after tax is 1980 plus 397. Then this multiplied by 1 minus T, or 1 minus 20% or 0.8. So this is the profit after tax of the combined company. Normally there's also synergy. Remember in the last question that we did, when companies combine, there's normally also synergistic benefits. And then after that, we need the PE. How are these given in this question? Let's go. Let's go. Here's a story. However, it is thought that the PE ratio of the combined company would fall to 14.5 times after the acquisition. So the PE now will be 14.5. The annual after-tax earnings will increase by 140 due to synergy benefits resulting from the from combining the two companies, meaning that in addition to this, we also have a benefit of 140. So what is the story? The story then is here. So this is the story now. So let us go. Let's go, people. 397 plus 1980 times 0.8. The synergy, 140. The total, PAT, as things stand, is here. That's the total. What is a PE? 14.5. So what's the value of equity of the combined company? Combined company. What's the value of equity? Let's go. We come there. Let's find the value of equity of the combined company equals that by that. This is what we have. I hope we have all seen evaluation method using PE combined company value using PE approach. So this is the value that we put here. So then, what is the maximum acquisition premium according to PE based? It's that figure minus that figure. So this is the acquisition premium, 1698. Gross premium or gross synergy. Questions? So if you ask me, so what are the answers? The answers are here. This one according to Strand. This one according to Hav. Of course, with practice, you can cut on the time and you can even cut on the computations. But this is presented to enable as many people as possible see through all the figures and to pick the idea. Are there any questions?
Sorry to take you back. I think I lost this network somewhere. Where did you get the synergy from?
Which one?
The synergy of 140.
The 140. So the 140 is here.
Oh, okay. After tax earnings will increase. Okay. Okay. All right.
All right. Let's ask questions. Let's ask questions. Okay. So in this question, if you ask me, Mr. P, what should we pick from this question? What you must pick from this part of the question for me is that how to find the value of equity using the PE approach. In the first approach, we learned about the CIV. Here, we've been given an opportunity to practice the PE approach to evaluation. Okay, if that is okay, I'm going to break this recording.